What next for UK interest rates, in particular buy-to-let mortgage interest rates? How low will they go in 2024? And I want to make you aware of a massive buy-to-let mortgage wealth warning that hardly anyone is talking about. Now, if you're new to this channel, make sure you subscribe and hit that bell icon. We're putting out videos each and every week, all dedicated to keeping you on top of your property investing game. Tell me what you think about what I'm saying in the comments below, and don't go away without smashing that like button. Now, I did a video just a couple of months ago on what next for interest rates. A lot of that still holds true. I'll leave a link to that in there and you can see that video later on. But let me talk specifically about 2024, how low interest rates will go and what will happen to buy-to-let interest rates during the course of this year. And of course, that wealth warning, which is very, very important. Now, a quick summary of what's gone on. Of course, we have gone from record low interest rates of 0.1% to a base rate of 5.25% in 14 consecutive rate rises. That's all because inflation rocketed up to over 11%. Of course, that's under control now a little bit. The current rate of inflation is 3.9%, but of course the Bank of England target rate of inflation is 2%, so it's still nearly double that. Now, UK interest rates always seem to follow what's happening in the USA. The USA, the Fed has already said they're going to reduce rates quite dramatically during the course of 2024. But the thing is, you see, the Bank of England came under a lot of criticism for not raising rates fast enough in the beginning. And they say that that was one of the reasons why inflation ran a little bit of amok. And it's been a little bit more challenging to bring inflation down than in other countries with similar economies. So for that reason, although interest rates will come down in the UK, probably not as fast and furious as what will happen over in the US. That being said, I reckon by the end of 2024, we should see rates at 4 or possibly 4.25%. Where do you think interest rates will be by the end of 2024? Bung your comments in the comments below. Let me know what you guys think. Also smash that like button too. Now, that's all very well, but what about buy-to-let mortgage lending rates? Now, there's a lot of excitement in recent weeks. Lenders seem to be dropping their rates left, right and centre, both for owner-occupier mortgages and buy-to-let mortgages. But here's the thing, that's particularly because the mortgage market is particularly stuffed right now. Lenders do not have a business unless they lend. And they're out there competing for that mortgage business, which is why right now the mortgage market is fiercely competitive and we're seeing them all jostle for what little business there is out there right now. But the rate of those falls in mortgage product interest rates, I don't think will continue throughout the year. And that's because as rates fall a little bit, it increases affordability. There's already very limited housing stock out there. And the lenders will soon see that they've got enough business to go after. So they don't have to be as keen to be as competitive as they are having to do right now. So what I'm really saying is, although we will see some cuts in Bank of England base rates during the course of the year, I don't think we're going to see massive, massive falls in the buy-to-let lending rates that we see. One of the reasons that buy-to-let mortgage lending rates are different from owner-occupier rates is because of the stress testing that lenders need to do and the affordability checks lenders need to do. The Bank of England recently published a report on the whole buy-to-let lending sector and the effect it has on UK financial stability. And the logic here is basically psychology. If you're an owner-occupier, you're living in a home, you will do all sorts to make ends meet before you hand in the keys to the bank and say ta-ta. But with buy-to-let, it's not the owner's own home. So if there are financial challenges such as rate rises, economic downturns, or the rents aren't keeping up with the cost of borrowing, then the landlord is very likely to sell up or maybe even fall into arrears. What got the Bank of England a little bit excited about the buy-to-let sector is this graph here. And this shows the percentage of mortgages in 3-month arrears, particularly at the start of the global financial crisis at the beginning of 2022. And you'll see the orange line shows that the rate of arrears among buy-to-let loans increased at a much faster rate than owner-occupier loans. So out of all mortgages out there, only 9% are buy-to-let loans, but the buy-to-let mortgage market represents some £300 billion worth of mortgage lending. So the Bank of England's concern is that issues affecting buy-to-let landlords don't spill over and affect the wider economy and the UK housing market as a whole. So what does the Bank of England have in its toolkit to prevent that from happening? Well, it can place caps on loan to values. In the old days, when I got started in property, you could get buy-to-let loans at 95%, 90%, 85%. But these days, 75% is pretty much the maximum. The Bank of England have found that the 75% loan to value cap is really the maximum loan to value lending which gives stability. They've found that at higher loan to value rates, the rate of borrower default is much higher. Are you struggling to find your next commercial to residential conversion project? Well, over the next 2 years, virtually every UK bank branch will close. Banks are fabulous buildings in prime locations, and thanks to permitted development rights, they're really easy to convert to alternative uses under a light touch planning regime. My team have put together a list of over 500 UK bank branches which are poised for imminent closure. And for a limited period only, you can download this list absolutely free. Your next commercial property project is on this list, so download it now and enjoy the rest of the video. And of course, the other tool in the armoury that the Bank of England use is carrying out affordability checks. Now, these are basically about the rental income. So what is the rental income that the property is producing in relation to the mortgage payment that's going out? And usually there's a requirement for coverage. So the rent is much higher than the actual mortgage payment to allow for increased costs or increased in interest rates and the like. Now, the thing is, as interest rates have risen from 0.1% to 5.25%, under the Bank of England's affordability criteria, hardly anything stacks up. So here's the workaround that the lenders have come up with, and here is the wealth warning for you guys. You see, the Bank of England judges affordability based on the ability of the rental income to service the mortgage interest. So if the mortgage interest is too high, basically the buy-to-let mortgage is unaffordable. So what the lenders have done is they have dropped the interest rates. You see headline rates being offered sometimes at 3.99% for a buy-to-let mortgage. Now, that means that according to the Bank of England's affordability criteria, you will qualify for a buy-to-let loan. But here is the sting in the tail. Some lenders are charging up to 7% of the loan as an admin fee. So it doesn't take a rocket scientist to figure out this is very silly. Yes, you're meeting the affordability test because the affordability test is on the interest rate, but it doesn't include any arrangement fees that are paid. When I got started in property, arrangement fees were just £100 or so. Now they are up to 7% of the loan. I'm very, very surprised the Bank of England haven't picked up on this, because there is a massive time bomb for certain unwary buy-to-let investors. Here's the thing. You get a 5-year fixed rate mortgage. You get a nice headline low interest rate, but you're stung with a 5% or say 7% admin fee. The admin fee is added to the loan. So that first of all, you're paying interest on that admin fee from day one for that 5-year term. Now remember, at the end of that 5-year term, your loan has basically had 7% added onto it. So when you refinance that property at the end of the term, if that property hasn't gone up in value by at least as much as to cover the 7% admin fee, you're in negative equity. Now, that can be a massive problem in parts of the country where price increases are rather patchy. There is a potential tax issue as well. If you buy a property in a limited company for, say, £100,000, then your borrowings on that property should not be greater than your base cost. Now, your base cost is basically the cost of buying the property in the first place, any sort of buying costs like stamp duty and the like, and also any capital improvements that you've made. But let's keep the figures simple. You bought the property for 100 grand. You bought the property with a 75% loan. You're having a 7% admin fee added onto it. And then at the end of that term, you remortgage it again. Now, you can be in a situation where if you haven't had capital appreciation, your admin fees are added to the loan. And if the loan amount exceeds your original purchase cost or base cost, then you can have a tax consequence for that differential. Now, I do expect some of the excesses of lender admin fees to kind of come down a little bit during the course of this year. But I've got a nasty hunch that lenders have got a little bit used to charging some of these fees. So that being the landscape, what is the solution? Well, the only game in town when you're buying property is the BRRRR method. I've talked about this in previous videos, and we'll be covering this more later on as well. But this is where you buy, you refurbish, you rent the property out, and you refinance. You buy the property well, you buy it below market value, you also add value to that property. Now, doing a combination of those things basically builds in equity into the deal. That allows you to pay the admin fee, cover the admin fee off in terms of that equity that you've built into the deal pretty much on day one. If you focus on that, you'll do good deals. The other question people ask me, of course, is with interest rates on the way down, what should people do? Should they act now or wait? If you're remortgaging, if you're refinancing a property, perhaps hold on for a few months, see how it all pans out. But if you're buying, no. All is act depending on whether the deal is good enough. If you buy well and you're adding value, you're creating that equity, you're doing it based on the numbers at that time. And as long as it works today based on locking into a 5-year fixed rate, then do that deal right now. That's it for this video. Make sure you subscribe and hit the bell icon for more. See you guys next time. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet, we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street, we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.